The AI mid-cycle slowdown is basically the peak and the easy money of AI. And so if the money starts filtering back towards the other direction, I've laid out a pretty bullish case for Bitcoin if you haven't got it. If we're overestimating the inflation side and productivity is coming, if we're overestimating the hawkishness of the Fed from what Warsh said, and at the same time, the AI trade is not going to lose its earnings growth. It's just going to make it more difficult for institutions to stay long it the way they have in the past. Then all of a sudden, the lower volatility of Bitcoin will probably lead in. If we get above the 200-day moving average with everything that I just said, which is up north of 70 at this point, I do think that that's going to be the beginning of the next phase of crypto and the next phase of AI. We'll see if it happens in the second half of the year. I think it will.
For nearly 2 years, one trade has dominated global markets. Capital flooded into artificial intelligence, mega-cap technology stocks, and semiconductor companies as investors chased what looked like an unstoppable revolution. Every earnings report seemed to justify even higher valuations, while Bitcoin spent much of the year fighting through wave after wave of selling pressure. But markets don't move in straight lines forever. The question investors are beginning to ask isn't whether artificial intelligence is changing the world. It's whether the easiest profits have already been made, and what happens when institutional money starts looking for the next opportunity. That possibility could reshape not only the stock market, but also the outlook for cryptocurrencies, commodities, interest rates, and the global economy. Few people have been following these cross-market relationships as closely as veteran macro investor Jordi Visser. Rather than looking at Bitcoin in isolation, Visser studies how liquidity, inflation expectations, labor markets, government policy, and artificial intelligence investment cycles all interact. And after months of warning about the risks building beneath the surface of the artificial intelligence trade, he believes markets may be approaching a turning point that could surprise almost everyone, particularly Bitcoin investors. Before we dive fully into Jordi Visser's explosive analysis, please take a little time to like this video, subscribe to the channel, and turn on the notifications bell for more videos like this. Thanks for tuning in and enjoy the video.
This has been a bad year for Bitcoin with a lot of headwinds, starting with software, which we talked about a lot at the beginning of the year and how it got lumped in with everything that was built on code. Once the software stuff kind of bottomed, you got into what you said, which is complete agreement. A country like Korea, which was part of the energy for Bitcoin, moved everything into basically memory, and we've seen massive leverage and margin debt and everything else. So Bitcoin, which was always kind of the place you'd go to if you wanted to trade beta relative to tech, well, that ended, and everyone now has beta in tech where you can get 10 baggers in the span of a year. But then one other part that I don't think people fully embraced as the last leg, and I talked about it briefly last week with this whole debasement unwind where it got lumped in with gold and silver. The rationale behind that, which is starting to become more interesting to me, and I'm seeing some technical signs finally with divergences, which I'll finish this off with, but I think the debasement trade unwind, there is a direct relationship here between something we talked about a lot and something I was concerned about for really the last 5-6 weeks, but then last week talked about that I'm not as concerned about anymore, was this inflation uptick, particularly in core PCE, core CPI, with energy going higher. Well, obviously energy prices have collapsed. We've seen fertilizer. So you're going to get a negative CPI print most likely for the June number. Already for July, we have a negative number, but I still hear a lot of people going out to macro clients talking about poor core PCE still being elevated. Then you get Warsh in. The second that we went from the Fed effective rate, which is about 3.6, we crossed over that for the December rate of end of the year, meaning they had rate hikes built in. That was when Bitcoin had the last leg lower. I think we've hit the peak of that. I really do. This is where the debate's going to come in. I am much more negative, in my opinion, on the jobs market getting better. And I think that is the difference. I listened to Darius Dale, who you've had on recently and who's a friend of the show and someone I respect, but I respect knowing what he's saying because I know his clients are responding to it because he's had such a good call on things. And I just listened to him post something yesterday where he talked about wage inflation. And I think that's where he and I disagree right now. I don't see the labor market as improving, other than the fact that we've had more jobs. Some of this is related to the World Cup, but on the parts related to AI, there is no bounce whatsoever. The business side, the insurance side, all of that stuff. And I think people are underestimating the next part of AI, which is the application layer. The infrastructure side is going to slow down. So I'm just going to tell people technically, we've got some nice divergences finally. We made new lows in Bitcoin, not just from the lows from a couple weeks ago, but also the lows from back in February. And it held in there. We've seen a lot of selling in the Bitcoin ETFs. So I'm more interested in paying attention now. Like I've said, until it gets above the 200-day, I don't think it's worthwhile for people to play on the other side. But I do think the narrative is old. And now I've been able to find something where if the wage side doesn't improve, meaning if we don't get a big change and we get I think any weakness now that starts to show up from AI agents, I think is going to be a positive for Bitcoin. Well, this is where the story gets very good for Bitcoin. So about 4 weeks ago, I talked and I started doing videos on the AI midcycle slowdown. I don't think people really listened to me. I don't think they really cared, but these names have been hit pretty hard and they're going through a slowdown. The reason they're going through a slowdown, these headwinds are never going away. So let me rephrase that. These headwinds are never going away. So I think people have to adjust their expectations. And this goes for Korea. This goes for Micron. This goes for everything. We talked about Micron having blowout numbers last week. Stock is down a decent amount since that report. That was the high. When you sell off on great news, that is not a good sign. And you have to dig a little deep. The reason these headwinds or that we're at a point is the headwinds are real. The government shut down one of the models. The Korean models are catching up. We're at a stage where the governments are getting more involved. This is a headwind that people have to understand. If governments are getting more involved with companies, Sam Altman proposed a 5% stake to the White House. I think we're getting back into what Bitcoin was meant to represent, which is when the government gets too involved in the capital markets, in the fiat system, in the ability to make money in these things, which is what happens when you shut down the models, when you slow down. On the data center side, we are absolutely having problems getting data centers in. This is, again, about politics. You've got a lot of people spending a lot of money in these elections. On the social democrat side, they are doing everything they can. On the Republican side and on the tech side, they're doing everything they can. We are at a point now where I think people have to realize that AI is a disruptive force and the models from here only get better. So what I was talking about in the first quarter, we're not going to see that easy trade again. It's not coming. And so the benefits are going to be to the companies that are able to use the agentic side and get their margins up. And we're starting to see healthcare stocks and financial stocks start to outperform the market. And that's why we're seeing this rotation, because tech has been the big winner. The infrastructure has been the big winner. I still think over the next 5 years, you're going to get great returns in these things because the build that is going to happen. It's just not going to be as easy. And I think that's good for Bitcoin.
Visser's argument starts with a simple observation. Bitcoin hasn't struggled because its long-term fundamentals suddenly deteriorated. Instead, it has been competing against one of the strongest technology rallies in modern market history. For much of the past year, investors looking for high returns didn't need Bitcoin. Artificial intelligence infrastructure companies, semiconductor manufacturers, and the largest technology firms were delivering extraordinary gains, attracting enormous amounts of institutional capital. In that environment, Bitcoin temporarily lost its role as the market's preferred high-growth asset. But Visser believes that backdrop is beginning to change. He points to several forces moving simultaneously. Energy prices have fallen sharply, reducing inflation pressure. Expectations that central banks would need to stay aggressively hawkish are beginning to soften. At the same time, signs of weakness are emerging beneath the surface of the labor market. Even as headlines continue to paint a mixed picture. What makes Visser's outlook particularly interesting is that it isn't based solely on Bitcoin. It's based on changes taking place across the entire financial system. He argues that investors have become accustomed to extraordinary gains in a small group of technology companies. But as volatility rises within those same trades, managing risk becomes increasingly difficult for institutional investors, which is why Visser believes the tide is about to turn sharply in Bitcoin's favor.
Well, again, one of the themes that I've tried to help with my subscribers on has been the situation that all these, including the NASDAQ, it's a modified cap weight. So it's not 100% cap weight. They do have limitations. But I do think NVIDIA is still a very large portion of it at this point. So it's been pulled back by NVIDIA, but it has a lot of names that have benefited from AI. So on the S&P 500, again, as of today, you're probably up about 8 little bit percent, maybe a little bit less, 8 and change is my guess, which is a little surprising given the fact that earnings are up as much as they are. But I think in the case of the S&P, it is a cap-weighted index, and you suffer with cap weightings in the fact that you're heavily weighted towards the winners of the prior 15 years and you're underweight the losers. Well, if the semiconductors are winning and they were not the winners and the hyperscalers are losing, then you're suffering in that side. I still believe stocks are going to outperform bonds for at least the next couple of years until AGI starts to become a little bit more scary. I still believe that commodities are going to be a big necessary, including silver. And I still believe that Bitcoin is going to be the best performer out of all of them once we get to the point that the negatives of AI start to become apparent. And I think they're becoming apparent right now. If the best you can get from the S&P 500 is just a guess, or Qs is 15% a year. Well, that's the world that Bitcoin thrives in. If you can get 100 to 1,000%, which is the world we've been living in for retail, which is the energy of Bitcoin, well, then Bitcoin's going to suffer. I think that world's going away. And more importantly, for people that are invested in private credit, in private debt, which wealthy people are in real estate, I think gradually over time, especially when the S&P starts to run into some bigger resistance, the volatility now is in the equity market. I've shown this repeatedly. Remember when Bitcoin was such an extreme volatile position? Well, now when Bitcoin has a big down day, it's down 1.5%. So it's moving on a 30 vol. Not even a 30 vol using that. I'm telling you right now, the tech momentum index, the last 60 days is an 85 vol. That's higher than any time over the last 25 years, including the dot-com bubble. Now, a momentum index like that is long short. So that has the winners of tech over the losers of tech. Well, that's the way most hedge funds run their book. When you have an 80 volatility, that prevents you from having much of a position in that because you'd be hitting your drawdown limits very quickly if you had that trade on. This is what's happening in the equity market, and this is not something that people should minimize. In fact, I've shown that over the last year, it's been a megaphone, meaning we're making higher and higher and higher volatility bands as we move forward. And that's going to make it more difficult for people to be long stocks. The Sharpe ratios are going down. And as we go forward, I'm going to say it again, the AI mid-cycle slowdown is basically the peak and the easy money of AI. And so if the money starts filtering back towards the other direction, I've laid out a pretty bullish case for Bitcoin if you haven't got it. If we're overestimating the inflation side and productivity is coming, if we're overestimating the hawkishness of the Fed from what Warsh said, and at the same time, the AI trade is not going to lose its earnings growth. It's just going to make it more difficult for institutions to stay long it the way they have in the past. Then all of a sudden, the lower volatility of Bitcoin will probably lead in. If we get above the 200-day moving average with everything that I just said, which is up north of 70 at this point, I do think that that's going to be the beginning of the next phase of crypto and the next phase of AI. We'll see if it happens in the second half of the year. I think it will.
Whether Visser's timeline plays out exactly as he expects remains to be seen. Markets rarely move in perfect sequences, and unexpected economic data, Federal Reserve policy shifts, or geopolitical events can always change investor sentiment, but his broader message reaches far beyond Bitcoin. The next major winners may not simply be the assets that performed best over the last 2 years. They could be the assets that benefit from the next rotation of institutional capital as artificial intelligence matures, productivity improves, inflation pressures ease, and investors begin reassessing where the best opportunities truly lie. If that transition is already beginning, Bitcoin may be entering a very different phase than the one investors have experienced throughout the past year. And if Visser is right, the biggest story isn't that artificial intelligence is ending. It's that the relationship between artificial intelligence, financial markets, and Bitcoin is evolving, and that evolution could define the next major investment cycle. If you enjoyed this breakdown, don't forget to like the video, subscribe to the channel. Thanks for watching and see you in the next one.